My name is Courtney Younger, and for my financial analysis project, I did Kellogg's versus PepsiCo. The first set of ratios we're going to take a look at are the profitability ratios. In particular, the gross profit ratio. The gross profit ratio is the measure of the amount by which the sale of inventory exceeds its cost per dollar of sales. It equals gross profit divided by net sales. If you take a look to the graph to the left, these numbers are generated from the year 2018. The information on the right is a percent in increase taken from the past year to the current year. Return on assets is the net income divided by average total assets. This measures the amount of net income generated for each dollar invested in assets. As you can see, PepsiCo is about double Kellogg's. Return on equity is net income divided by average stockholders' equity. This measures the income generated per dollar of stockholders' equity. The next set of ratios we're going to take a look at are the liquidity ratios. The debt-to-equity ratio is total liabilities divided by stockholders' equity. This measures a company's risk. If you may notice, Kellogg's is typically behind PepsiCo, but in this scenario does have a larger number. In this particular case, that's not the best thing. Having a higher number is just measuring the company's risk, which means Kellogg's company has a higher risk. The asset test ratio is cash, current investments, accounts receivable divided by current liabilities. This measures the availability of liquid current assets to pay current liabilities. The current ratio is current assets divided by current liabilities. This measures the availability of current assets to pay current liabilities. The last set of ratios we're going to take a look at are the risk ratios. The accounts payable turnover ratio measures the speed with which a company pays its suppliers. If the turnover ratio declines from one period to the next, this indicates that the company is paying its suppliers more slowly and may be an indicator of worsening financial conditions. The inventory turnover ratio is the number of times a firm sells its average inventory balance during a reporting period. It equals cost of goods sold divided by average inventory. The last ratio we're going to take a look at is the receivables turnover ratio. This is the number of times during a year that the average accounts receivable balance is collected or turns over. It equals net credit sales divided by average accounts receivable. Overall, these companies are relatively similar in the market and in the accounting numbers. During class, I did have Kellogg's, so my heart does pull for Kellogg's a little bit. But if you did notice in the presentation, PepsiCo is overall a better company when it does come to the numeric numbers in accounting.